you for being here today. We know you're all busy, and we're happy to have you. My name is Jeffrey Cates. I'm a partner at the Founders Group. We do business transition planning with business owners, value acceleration as we prepare companies for their eventual exit. At this time, I'd like to introduce everybody that's here, that's part of this group. We're a small, select group. We're like-minded professionals focused on supporting and advising middle market business owners, their families, and management teams throughout the life cycle of the business. And we also do a lot of this through personal advisory services as well. A lot of us are transactional professionals. We also do not just the sell side, but also the buy side. We're not really focused on that today, but there's a lot of that work that's done as well by the members on the team. The group consists of, the core group consists of attorneys. We have transactional attorneys, estate planning attorneys, CPAs, doing M&A work and advisory services. There's an investment banker on the panel. I do business transition planning, and there's also wealth advisors. So when you look at it all together, we're kind of like a core group that provides a multidisciplinary area of services because as you're looking at transition, all these things come into play. And there is no one-size-fits-all out in the world. Everybody has their subject matter expertise, and they're all critical when it comes to planning for an eventual transition, which will happen. And the goal is that you get to control that process and not have it control you. Our mission is to educate and serve middle market business owners by providing collaborative advisory services and value-added solutions that address their needs throughout the business life cycle and beyond. And that's what we're committed to here. Today, you'll be hearing about just an overview on succession planning and a middle market update. Every 3 weeks, we'll be having these next two presentations. 3 weeks from today, we'll be doing preparing for the business transition itself. And then 3 weeks following, we'll be talking about actually executing the transition plan and what would your life look like after the transition, because that's a very big part of the process. Some statistics, all right? 70 to 80% of privately held businesses that are put on the market won't sell. That's a staggering number, and these have been proven out. And so the question is, why won't they sell? Well, one of the main reasons is that business owners, they have this expectation gap about what they think their business is worth versus what somebody's willing to pay for it. And that can be very shocking during the process. And if it's not uncovered or determined what that value is in advance, a lot of deals get derailed because when it comes time for the letter of intent and somebody's offering 12 million and you think it's worth 20, you'll be walking away. That deal won't get done. Other reasons are, as you go through due diligence, your business may not be as attractive to an outside purchaser than you think that it is, right? Businesses, people that are looking to buy businesses, whether they be strategic, financial, they're looking for the cream of the crop. I mean, the market certainly calls for that today. You have to really stand out over your competition. So you have to be attractive, first of all. And once you're determined to be attractive, the question is, are you ready? Because once due diligence starts, the offer never goes up, right? That letter of intent is the highest number you're ever going to get. But during due diligence, that number can come down, and most often does, especially if you're not ready. That's where these acquirers hammer down that sale number. So what you think you're going to be getting at the beginning of the process, when it's whittled away, deals are often derailed during due diligence. Another reason is that an owner may not be prepared for the transition. What are you going to do afterwards? Has it been discussed with family? Do you have a plan for what to do afterwards? You've built this business that's been your life for so many years, and you've built it up, and it's part of your fabric. And now it's time to sell, and now what? Do you have a plan? And a lot of business owners get cold feet. They get scared because their identity is tied to the business. So planning for what you're going to do afterwards is a critical component. And there'll be people on the panel talking about that as well. So, this is just a chart, if you can see it. And it's just really what it's saying is that for most business owners, your net worth, the value of your assets are tied up in the business. Now, it's not 100%, for everybody, but a lot of business owners have their wealth tied up in the business. And so how liquid are you? How do you handle that? How do you make that asset work for you and have it be part of your legacy that you're planning for as you put together a plan for transitioning? So it's just something to think about for all of your own lives and businesses, how your personal situation is affected by that. We find that majority of business owners, they don't have a transition advisory team working collaboratively. Okay, a lot of business owners, they have lawyers, they have accountants, right? And they have wealth advisors personally. All these people in the room, what they don't have is a team that's collaborative, working together, and planning in unison with one strategic plan in place that takes care of all of the needs of the owners, in congruence with a personal plan and a business plan. So that's part of where we come from today as part of this group is we're multidisciplinary and we all work, towards the common goal of helping business owners. Another key point is, do you know the value of your business today? Do you know what your business is worth? That if somebody came up to you today and said, love your business, I want to offer you X. Is that accurate? Do you have IP? Do you know the value of your intellectual property? Is it worth more? Where do you stand? How do you know whether or not to say yes to that deal? So going into the whole plan of understanding the value of your business and having a valuation done is pretty important at the beginning of the process. And most business owners, if you ask them, they may have a ballpark or an idea, but most business owners are running their business on a day-to-day basis and may not have a clear understanding of what it's worth. All right? And do you have estate and tax plans in place that deal with what's going to happen to the business and what's going to happen to the assets upon transition? Is that in place? By a show of hands here, if you'd like, and please feel free to share, and nothing is leaving the room. But do owners have business continuity plans in place? Great, that's great. But having a business continuity plan is important. Now, so I would ask you, now you have a business continuity plan in place, do you have a contingency plan in place for, God forbid, somebody gets hit by a bus today? What happens to the business? Can it be up and running the next day with you not there? What happens to the value of that business if you're not around? Is there a plan in place? Very important, for divorce situations, partnership disagreements, is what is your plan to move forward if something were to happen? And then, another point is, what does your life look like after the transition? Do you want to open a new business? Do you have hobbies? Do you want to travel? Grandkids, whatever it is, knowing what that plan is going to look like is going to make it much easier to transition. So without further ado, what we're going to do is we have 4 presentations today, and I'm going to pass it over to Ray Chase, who is a partner at Certus Financial Group, which is part of UBS.
Just so everybody knows, your microphones work, so if you would like to try to see the so anyway, start there. Thanks, Jeff. My name again is Ray Chase. I'm part of Certus Financial Group within UBS Private Wealth. We operate out of Manhattan as well as in Florham Park. I'm a certified exit planning advisor. So my job here today is going to really kind of create some definition around what succession planning is, We'll talk about some statistics and research that we've done around interviewing business owners and some of the issues and challenges. And lastly, we'll talk about some ideas that you might want to contemplate before, during, and after the transaction. So let me get rolling here. So I put up on the top here succession, transition, exit planning. The reason I did that is that in our world, those words are used interchangeably. So whenever you hear any of these phrases or words, just understand that people are probably talking about the same thing. So, and what I'd like to do is just define for you how we define these terms. So from our standpoint, the succession plan or exit plan combines the plan, concept, effort, and process in a clear and simple strategy to build a business that's transferable through strong human, structural, customer, and social capital. It aligns the business, personal, and financial needs of the owner, and it's not just a plan, it is a strategy rooted in execution that can help grow value while expanding options so that the owner can transition the business on his or her terms when they're ready. I read that because I can't memorize that much stuff. But so that's how we define succession or exit planning or transition planning, that kind of a thing. You know, the misconception is that this is the end game, and the reality, what this is just good business policy, and if done right, is not only going to enhance the value of that business when you exit, but also produce somewhat better results along the way. Here's a fact, and I think Jeff was talking about, 80% of the businesses that go to market don't sell. The reality is 100% of business owners are going to exit their business anyway. So it's you want to think about this either from a passive or an active standpoint. So you think about the passive side of things. You're the business owner that's just waiting or hoping that nothing goes wrong, and if it does, it'll be solved and it won't be a problem. We use the 5 Ds as kind of the things that can't come up that you have no control over. Death, disability, disagreement, distress, divorce. Those kinds of things can pop up, and it really limits then what your options are and your ability to impact the outcome because you're reactive as opposed to proactive. So on the active side, this is someone who's, all right, I'm going to address these 5 Ds in my structure, my documents, and make sure I have a succession plan in place should something happen that I can't control. But just as important, I'm going to have a game plan for what my ultimate exit's going to be and how I'm going to do that. So having a game plan there. So now let's talk about some of the research that's available that we did this past summer. And I'm not going to hit on all the details on these slides because there's a lot here, but I just want to hit on the highlights. On the first thing here is that, basically the economy is really good. The market and valuations are high for middle market companies and businesses in general. I think what most of the people in the room here that are in this industry would agree that this is probably one of the better markets they've seen in their careers. And owners are looking at this as an opportunity to cash out. And how do they do that? It's definitely a seller's market for companies that are prepared, not necessarily a seller's market for companies that are unprepared. So what's on the horizon? Basically, if you look at the stat on the top left there, 41% of the owners that we've surveyed said they want out in 5 years. And if you extend that out to 10 years, that's 60%. So while the market is good now and probably for the near future, there potentially are some clouds on the horizon in the sense that, you think back to your Econ 101 classes when you're in college, keep demand the same, increase the supply, price comes down. So just understand that there's going to be more volume coming to market as we get into the future. And as Jeff said, 80% of these companies that do come don't sell. So I want to talk a little bit now about why that is and where the issues are. So the key reason that these businesses don't sell is that there's just fundamental steps that are not taken. And I'll just hit on a couple things on this slide here that address that. Essentially, 75% of the business owners underestimate the process, meaning they think it's a 1-year deal and I get this done and I'm good. The reason that's not the case is that, there are some things that you can do and it take 3 to 6 months to implement that helps valuation, but there are a lot of things that can take 2 or 3 or 4 years. A couple that come to mind, you need a next tier of management. You just can't grow that overnight. That's somebody you have to cultivate over a period of time. So, that could be a 2, 3, 4 year type of a process. And the second thing is if you have customer concentration, that's a risk for a buyer. You need to diversify that away. That can take a couple of years as well. So getting ahead of this, and it's a bit longer than a 12-month process. A couple of other things I think on a high level, more than half the people have never had a formal valuation, to Jeff's point. Don't have audited financial statements. don't have a defined succession plan. These are just kind of the baseline things that need to get done in order to make sure that you're in a better spot. Any questions so far? No? Okay, good. So if you're thinking, well, you know what, I'm just going to pass this business to my heirs instead of selling it outright, we have to think about that a little bit. You know, the reality on this topic here is that basically your kids don't want the business, they want the money. Now, that might not be a surprise to some people, but generally speaking, they just don't want the business. And even for those owners that say, you know what, I do have a son or a daughter that's really interested and I'm bringing it into the business, there's still some reservations around this topic. Particularly, can they manage this? Can they handle this responsibility well? Will there be financial conflict within the family as a result? We might have one child in the business, one out. How do you manage that? Even two children in the business, or maybe two cousins in the business sometimes. So are they ready for the responsibility? Can they manage the business? What about the conflict? So it's not without some agita in that regard. So here, the other element that I think no one really talks about, which really surfaces after the deal, is being ready for life after. You know, this is a situation where you have business owners, they sell their business, they've had that congratulatory meeting, champagne's open, the check's in the account, everything's great, and not there long thereafter. A little more than a third of those owners would report back and say, I feel a sense of loss now, you know, and as a result of this sale, which makes a lot of sense. You know, if you've incubated this business out of your garage and grew it over the last 2 or 3 decades, there's a sense of loss here. This is almost like a child that you've raised. So, you know, the whole idea is that, you know, as part of your social network, you know, you think about your stature in the community. There's a lot of emotional elements to this, and that can't be understated. Or I'm sorry, it can't be overstated. So essentially what I want to do before you sell is really think about what your life after plan is. And that's really kind of taking an inventory of what you love to do and how you'd like to do it, whether that's engaging in the community, philanthropy, with your family, whatnot. But having a life after plan that you can execute on. So, you know, succession, where do you begin? What I'm going to do here is just really talk about some bigger picture topics, just more thoughts. And we'll start with pre-transition here. First thing we were talking about earlier is, you know, you have to start early. This is a 3 to 5 year process, not a 12-month process. So the earlier you can get on top of this, the better. Second thing is that you want to create your ideal vision. You know, I always think, somebody once said, you know, you start with the end in mind, and this is an example of that. What is the perfect outcome for you? What would you like that perfect outcome to be? And then you work backwards and try to create the infrastructure to make that happen. So creating that vision, and, you know, that's something you might engage with your spouse or what have you, or your family on, and talk about what the real important things are in your lives. But in my mind, what this really starts as a personal financial plan, because every other decision that you make is going to be driving to those goals that you created in that personal financial plan. Next up here is you know, steps and strategies. Again, start with the end in mind, create those steps and strategies. Hopefully you have your team in place that'll help you along with that. And the last is or understanding the impact of this transaction on your personal financial well-being. So, you know, you might have taken an illiquid asset, turned it into a liquid asset on your balance sheet, but you've given up the income that you had from that business. So what we usually do is we'll model out a number of scenarios for an owner, looking at different exit strategies, different exit scenarios, so that we can enhance or at least make sure that we're maximizing the end value of that business after tax. The last piece here is, you know, getting your house in order, your business house in order. You know, you really want to do is, you know, assess the attractiveness of that business and the readiness. And the attractiveness side of it is really what it looks like when you drive by from the outside. But the readiness is when someone makes an offer for your business and they're in the process of due diligence, they're starting to tear this up inside and look at all the different pieces to that business. So you really want to take a look at, you know, all these different aspects of your business so that you have them in good shape for when that due diligence process begins, particularly around financial systems, your management team, ownership structure, you know, process procedures, client base, things like that. Next thing on the pre-transition, and Jeff touched on this before, is really your team. So you have the business owner, you have your professionals, your CPAs, your attorneys, and whatnot. And the first part of this is really assessing what you have now. These people might have been with you from when you started this business. and through the growth phase, through the mature phase, are they the right people to have on the team for this next move, which is this transition? Do they have the depth in their team? Do they have the intellectual capital to help you through this process? Just do an honest assessment. They might be the right people. You need to, but you need to go through that and then fill in the gaps with the people that you need beyond that, whether that's an intellectual property attorney or an M&A attorney or an investment banker. Those are types of examples. I like to explain this or look at this more from this standpoint because it really talks to the collaborative aspect of this. Much better answer for the business owner. He's sitting there and he has a game plan or strategy or master plan that his outside team of advisors has collectively put together and viewed from a legal standpoint, a financial standpoint, a tax standpoint, and so forth, and have a collective answer that rolls up to the business owner to make a decision on. That's a whole lot better of an answer, in my opinion. Okay, so pre-transition, we're talking more about the personally and emotionally. So how do you handle this stuff? So first thing is letting go, which sounds like a kind of maybe a base like, I'm good at letting go as long as I have a big check in my account, but the reality is if you're not mentally prepared for this, it's a bad outcome. So you can get through 3-6 months of a due diligence process with a potential buyer, get to the 11th hour and not be comfortable selling the business because you're not ready. So you really have to give this serious thought. There's no right or wrong answer. The timing is a personal one, but just understand that this is something you need to kind of clear through your head and make sure you have confidence in your answer on that. Next thing is family wealth issues. Better to kind of address this now as opposed to later. You basically have a system where you have families or friends that might be looking for financial help after a transaction. You might want to just start thinking through how you're going to handle that in a healthy way. You have potential entitlement issues with the next generations possibly. You want them to be productive and not dependent. How do you communicate wealth to the next generation when maybe it hasn't been present throughout their lives? This change is something that's important and has some emotional and relationship type issues. Employees and vendors. For some owners, this is a key issue and will drive the exit plan that they have because these are the people that are almost like family to them. They've been with them for decades and they don't want to disrupt their lives, these people's lives. So, for example, you might have a financial buyer like a private equity firm as your choice. Their idea about how to manage this business going forward might be different than it would be maybe for a strategic buyer. So the employee's experience might be different as a result of that, or maybe what your responsibilities are post-sale can be different as well. So just have to give some thought to that aspect of things. So moving on. So you've decided, all right, I have a buyer, I'm moving out of my life. We're going through the due diligence process. The point here is that you have to remain focused on the business. There's a lot going on, and this can be a major distraction. So what you want to do is you want to lean on your COO, your CFO, and your team of outside professionals. Let them do the heavy lifting and keep focused on the business so you can avoid a deterioration in results. It's kind of like Jeff was mentioning earlier, that best number you're going to get is right at the beginning, and it can come down and will come down if business results start to tail off during this process. The last thing I'd say, basically, you want to manage this flow of information. So if you don't, they will. If the best that you can try to communicate what's happening within the business so that the rumor mill doesn't fill that gap for you, because that can create some morale issues and ultimately create some issues on the business results. Post-transition, we're going to start first off on the financial side. Essentially, you want to engage with your appropriate team. It's kind of like on the business side as well. Some of these professionals might be with you through the transition and will continue on. In other cases, you might have to add other people to the group or firms. For example, a trust company or something along those lines. So you want to make sure that you have the right team created here, and it should be collaborative as it was before. Second thing is you take a systematic approach to wealth management. Again, wealth management, I'd say, is probably an overused term that no one has a definition for, so I'll give you mine. Wealth management equals investment management plus advanced planning plus relationship management. Investment management is what you expect it to be. Create and manage a portfolio aligned with the client's goals and risk tolerances. It kind of goes without saying. Advanced planning, a little more in depth. talk about cash flows, managing cash flows, mitigating income taxes, estate planning and gifting, risk reduction and risk protection, make sure your assets aren't unjustly taken from you from a liability standpoint, and charitable giving. Those are kind of the bigger categories I would touch on there. Relationship management is how you engage with your wealth management team from an ongoing basis. So, next thing, manage cash balances effectively. So, you got this big check in your account, what do you do? And I'll just use two examples that come to mind to illustrate what not to do. Have a client sells a business, $30 million lands in the account, and he's afraid of losing a penny of that. So it sits there for 6 months, 1 year, 2 years, 3 years, and you can understand there's an opportunity cost of doing that. So, and then on the flip side, you have a healthcare tech business sale. He gets his check in the account and he basically splits it among 5 healthcare stocks because that's the industry he knows. Both of these are extremes, and you just want to avoid the extremes. You want to have a methodical, disciplined approach to how you're going to redeploy this money that is now liquid in your balance sheet so that it makes sense and it's consistent. So, enough said there. Last thing is plan for the estate. We hope that you had done that before you did the sale, because that's when you have a lot more leverage that you can take advantage of things. But if you haven't done that before, you want to do that now. Personal legacy. This is the last post-transition thing that I'm going to talk about. The first thing you want to do is go, execute on that life after plan that you did earlier. Go have fun, engage with your family, in the community, philanthropy, mentoring, whatever it is that you found that really makes your life fulfilling, you go do that and make sure you go execute on that. Second thing is redefining your family relationships. So you've been at this company working for 20, 30 years, and you're spending 8, 10, 12 hours a day there, and you come home and the family's there and you have dinner and you go on with your life. So day 2, after you sell, you're sitting at the kitchen table at 7:30 in the morning and nobody's there and you're wondering where everybody is. Well, they have a life too. And the point here is just understand this is a transition for you, but it's also for them too. So just understand there's an emotional element there and a lifestyle element, and communication is really the key here. And so that everybody kind of lives the life that they'd like to do, and you kind of re-engage. So next piece, impact of new wealth. Touched on this a little bit earlier, but just understand that a big liquidity event adds a little complexity to our lives and our relationships. Just one of those topics that we attempt to delve into a fair amount with clients. And lastly, preserve the family and family assets. Again, similar to the third point there. Having a family offsite meeting where everybody's on the same page, understanding what the family's all about, what do we stand for, what are our values, really is a valuable way of going about preserving that family dynamic in a positive way, as well as the assets for generations. So, and last thing is defining your legacy. I have John McCain here because I think he's defined his legacy, probably not by taking any certain thoughtful approach to that, just the way he lived his life, but you have an opportunity here to impact the lives of others, and you think about how do you want to be remembered, so I think it's an important thing. So that's all I have. Take any questions that come to mind.
Ray, do you have any stats around success of family business transitions?
Yeah, that's a good question. I didn't really touch on that in the presentation here, but according to the Family Firm Institute, business that transition within the families, the success rate there is not particularly good. When you look at the second generation, the success rate goes down to 30%, and then the third generation is 12%, fourth generation is 4%. So it really just gets whittled down pretty quickly, and part of that is some of the things we talked about earlier. There's some issues around that.
Yep. We didn't really do this, but by show, as a business owner, there's different types of ownership structures, right? An owner may be part of a multi-generation where they have kids in the business or they're a child. You could have siblings in the business. It could be part of a management team. Every business is different, and it's, there's no one size fits all here. Somebody that has brothers in the business and how they're going to handle that transition is going to be much different than somebody with 2 kids in the business, right? So there's no one size fits all. There is, however, the fact that a plan needs to be introduced, whatever that may look like. Any takeaways?
Yeah, I'd say succession planning is is not an end game. As I mentioned earlier, it's just good business practice, so I think you look at it from that standpoint. Second, the market's really good, but there could be some clouds on the horizon related to that. And I'd say, don't count on keeping the business within the family, just based on the stats we just talked about. And lastly, get the right people in the room with you, the right professionals.
All right. Good, thanks. Thanks, Ray.
Thank you.
Next up is John McIntyre, who is partner at Garrity and McIntyre, and he's going to be talking today about the state of the middle market.
Thank you, Jeff. Again, my name is John McIntyre. I'm a CPA in a firm called Garrity and McIntyre. We're in Florham Park, New Jersey. I've been practicing probably 30, 35 years, primarily representing buyers, but have done probably 10 to 15 sell-side assignments. We're a small firm. There's only 10 of us in the accounting firm, but one of my specialties is buying and selling businesses. So with that said, the state of the middle market. Right now, we're going to define the middle market as companies with enterprise values of $1 billion and less for purposes of this discussion. And right now, I'd say most M&A professionals would say that the middle market is very hot and healthy. I'd even say frothy, just like Ray mentioned. U.S. and world stock markets are at an all-time high, and interest rates remain at historical lows, although we have seen 3 interest rates spikes in the last, in this year. So it is worth noting that the IPO market remained hot in the second quarter. However, this represented only 2.9% of exit value in the quarter compared to 3.5% in the first quarter. Secondary buyouts accounted for 51% of all middle market PE-backed exits. The second straight year the secondary buyouts were greater than 50% of middle market deals. Is anybody unfamiliar with what a secondary buyout is? Okay. You? Okay. Secondary buyout's one PE shop buys a portfolio company of another PE shop. Fundraising activity right now continues to trend toward the larger funds. General Partners closed on 73 middle market funds, raising $61 billion in the first half of 2018, a 4% decrease in the number of middle market funds raised, and a 30% decrease in the dollar amount raised from the first half of 2017. The average middle market fund size, sorry about that. The average middle market fund size for the first half of 2018 was $841 million compared to $669 million for the first half of 2017. The median middle market buyout size rose to $177.5 million in the first half, a slight decrease from $182 million for the full year of 2017. Corporate acquisitions and secondary buyouts continued to gain ground compared to IPOs as they're expensive and time-consuming. Loan market activity continues at record levels. So, okay, we went through that. Let's go to the first slide here. This is an interesting slide. And as you can see, or you may or may not expect, middle market activity has increased since 2008. You see the spike in 2007 in terms of the number of deals and the dollar amounts. You see the 2008, 2009 crash. And then since then, middle market deals have increased almost on a hockey stick type projection. And then you see what's happening in 2018. Now, that's only a half year of 2018, but from what we can tell so far, it doesn't look like 18 is going to be quite as prosperous as 15 and 16 and certainly 17. So we can go to the next slide and we can see what market multiples look like. The market multiples on the left side of the axis and the years are on the bottom. So for deals that are less than 500 million, that's the lower level, the red shade, red-colored analysis. You can see the multiples for deals under 500 million. For deal sizes greater than 500 million, you see the blue tracking. So clearly, you know, bigger is better. The more revenue you have, the higher multiple you're going to get. So is anybody surprised by this slide? Okay.
John, I'm sorry, I just want to interrupt for 1 sec here. Does everybody understand the concept of multiples as it relates to your business and what's driving, and that the fact that multiples drive value? So that's a critical slide, is especially for the market under 500 million, which is probably most of you in the room, is multiples drive the value. So that slide's very key.
Yes, yes, yes. Any questions? Okay. So then the next slide shows the middle market debt to equity ratios. And surprisingly to me, they've remained relatively flat in the last 10 years. You know, the debt ratios right around 50%, 51%. And in the world I play in, that's kind of unusual because most of the deals we do are highly leveraged deals where the buyer's putting in 10%, 15%, sometimes as little as 20% equity, and then leveraging the balance. This chart doesn't say that at all. It says, you know, for most middle market deals, you know, it's about 50% leverage. All right, then lastly, we can see deals under 100 million, 100 million to 250 million, 250 to 500 million, and then deals $500,000 to $1 billion since 2007 to 2018. I'm not going to read the chart to you, but you can see the stats. You know, most of the deals in the space are done under 100 million. A fair amount done 100 to 250 million, and then very small amounts in the 250 to 500 million and 500 to $1 billion range. At the bottom of that chart, you can see the number of transactions done in that space over that period of time. Now, my only take out of this is for 2018, again, these are 6-month numbers, the numbers don't look anywhere as close to 14, 15, 16, or 17. So, you know, what's driving that? You know, interest rates have ticked up a little bit. That could have something to do with it. The fact is we're in the 9th year, or 9th and a half year of a bull market, and, you know, markets run in cycles, typically 10 years on average. I just think with some of the trade tariffs that are being imposed, interest rate increases, and people getting jittery, that you're going to see deals, the pace of deals slow down. So let's turn to the next slide then. Potential issues and concerns. Like I just said, many think we're at the near or at the end of a current bull run. Current U.S. economic expansion just celebrated its 9th birthday, appears to be 1 year away from surpassing the 90s expansion as the longest period of uninterrupted growth in American history. Concerns about potential trade war. Two key Tax Cuts and Jobs Acts will impact deal-making prospectively, and I think I may have glossed over that earlier. First, CapEx deductions. With the new Tax Act, you're allowed 100% bonus depreciation, including used equipment acquired via asset deals, versus prior law, which only allowed 50% bonus depreciation, and that was on new equipment only. And then there's going to be a cap on interest expense deductibility. So your interest expense prospectively is going to be limited to 30% of EBITDA, further limited in 2022 to 30% of EBIT. Now, you know, why does that matter? It matters because firms are not going to be able to deduct the interest expense on borrowings. So the buyers are going to be less willing to pay hefty multiples to acquire your company. Now, they may need the debt to buy the company, but they're only going to be able to deduct the interest expense subject to these limitations. So you're going to see some price compression. Lastly, you're going to see likelihood of interest rates continuing to rise. As that happens, transactions become more difficult for buyers as borrowing becomes more expensive and time-consuming, and again, often result in price compression. So what are the takeaways? The market is still very hot. Like Ray said, no one can say for sure how long that may last. PE firms continue to stockpile record levels of capital. You have too many PE firms chasing too few deals. Right now, it's a great time to be a seller, assuming you've prepared. You've met with your team, you've gotten your balance sheet in order. Interest rates remain at historical lows. It allows buyers to fund deals and often pay multiples higher than what the market would normally warrant. Many PE firms and hedge funds continue to adopt what's called the buy and build approach, rather than wait for organic growth. Inorganic growth allows PE firms to put capital to use and eventually return capital and profits to their investors. Right now, we're at the greatest generational transfer of wealth in the United States will occur over the next 15 to 20 years. Some people argue it's happening now, as baby boomers retire. It's estimated that some $300 trillion will be passed to the next generation, with a significant amount of such wealth generated from the sale or exits of middle market businesses. So, again, the focus on what we've talked about thus far is primarily sell side, but we also help people buy businesses. I'm working with several different groups right now in an industry I'd rather not discuss, but the concept we're working on is to buy these businesses at a 3 to 5 times multiple, and if we acquire enough of them, get to a level where we're at 100 million in revenue, and we're going to exit at a 7 to 9 multiple. That's not it's not an atypical strategy. Does anybody have any questions?
John, so, we've presented a lot of facts about the middle market. What I'd like to do is maybe kind of tie it into what that means for the business owner today in terms of almost, should anybody be chasing a deal because of the market, or is the market what it is at the time that somebody's ready to do a transition?
I would say you never want to chase a deal. That goes against everything I've ever learned. A business owner has got to assess, first of all, is he in the buy mode? Is he looking to grow his business? Does he have a transition plan in place? Hopefully it's a documented transition plan. And is he buying, growing, and he can meet with investment professionals such as ourselves to show him how to do that? Or is he selling? And if he's selling, as Ray said, there's a whole lot of issues to address, to take care of. You've got to make that decision what you want to do and then plan well in advance for it.
Right. I agree. What I'd like to say to that is take care of in-house first, because you can't control the market. But in tight markets, your business being more attractive than the others will still command a premium, and your business will get sold if that's the time that it has to happen in. And in good markets, the multiple will be even higher. But so planning for your business is really not market driven. It's irrelevant, right? You're trying to just capitalize capitalize on adding that value, regardless of what state the market is in, so that you can be proactive. That's really what I was trying to say.
I have a couple.
Sure.
Questions. First off, you showed a couple slides there where for 6 months in 2018, it looks like transactions are way down.
Volumes are
But you
down.
used the words like healthy, frothy, robust. Seems kind of contradictory.
I just want to interrupt. That was it's 3 months. That's that on the slide. It was 3 months.
Okay.
Yeah.
And then the other one you just mentioned, kind of acquiring some lower middle market companies at a 3 to 5 multiple, packaging up into a 7 to 9 multiple. Yet again, on one of your slides, you were showing multiples on that sub $100 million up around 20%.
It varies by industry. I mean, the multiple you're going to get is industry driven.
Understood, but that's a pretty big gap. So I'm just trying to.
Yeah, I mean, you could be dealing with a manufacturing business and be in a 3 to 5 multiple. You could be in software as a service business and get, 15 to 18 multiples. I mean, I've got a trucking business right now that's selling for like 33 multiple. So it's kind of, the multiples are all over the place, but they're primarily industry driven.
I just had a couple points I wanted to address. On terms of the activity in the market and what we're seeing, we're an investment banking firm. I'll introduce myself in a minute, but we're seeing there's been a bit of a delay in activity. A lot of companies were holding off on trying to sell, and you got to remember the sell process is a 6 to 9 month process, and there was a bit of a delay because people wanted to see what was going to happen with the tax cuts, and they wanted to understand what was going to happen there, and that was going to help shape what they were going to do next, and that caused a delay in people getting prepared to go out in the market in the last quarter of last year, and that's created a little bit of a dip in the first half of this year, but the expectation is the second half of this year, and we're already seeing it, is extremely busy. And then in terms of multiples, John's right on point, but you'll also see as companies grow, you're going to see improvements in that multiple. So you mentioned EBITDA. There are sort of thresholds of EBITDA where people get a bump up in value. And 3, you'll see some level of interest. 5, there's another even higher level of interest. I'm talking in terms of EBITDA. And then once you get into 10 million in EBITDA, you get a lot more interest. So if you're a company that's generating $100 million in revenue, have 10% EBITDA margins, you're going to see a nice level of interest in your company and growth in that multiple that's going to be paid for it.
I just also want to mention the slides will be offered as part of, are the slides being sent out to participants? Right, so I know you don't have anything in front of you, but these slides will be offered. All right, thank you, John, appreciate that. Next up, we have Michael Rosendahl, who is a partner at PC Investment Bankers, and
Thank you. So yes, as I've mentioned before, I'm an investment banker. We're a firm based out of Winter Park, Florida. We have 4 offices, Winter Park, which is just outside of Orlando, another one in Chicago, a third one in Atlanta, and then I'm based in Ridgewood, New Jersey. And we have 2 sides to our business. We are a valuation firm, and we do everything from estate planning through fairness opinions, but the side that I'm on is investment banking. And the majority of what we do is sell-side investment banking, and that takes two forms. Whether you're trying to sell to a third party, whether it's a private equity firm or strategic buyer, but we also have a practice that is ESOPs. It's a tax advantage strategy to sell your company, and we try to be agnostic about how you sell. We just want to find the best strategy for you personally. So when you look at your different succession options, there are largely 6 that you can that a seller could evaluate. The one in the bottom right-hand corner, sale, IPO, I don't think that's really part of this group, but it is an option for middle market businesses that grow. Most of what we see are those others, the sale to a strategic buyer, sale to a private equity group, a leverage recapitalization, an ESOP, which I mentioned just before, and a management buyout. A lot of the characteristics you'll see in a leverage recapitalization and a management buyout are very similar to a private equity. There's some transfer of wealth. There's a way to take money for the owner to take money out, but it has a lot of characteristics because you either need to bring in some equity, you need to bring in some debt to help fund the company. To build on the comments that I've heard before, and just to reiterate on the preparation is one of the most important things you can do. Anything you can do to mitigate any sort of concentrations you have, anything you can do to create that depth of management, it's only going to add value to your company. We start speaking to companies 5 to 10 years before they want to sell, because we can add a lot of value to them by just giving them a little advice here and there and helping them make little changes that will create value down the road. And we also want them to speak to people like Ray. One of the points you brought up was people have, valuation they have a misunderstanding about what they think the value of their company is. And to us, we're going to have that conversation with you. We're going to make sure what you understand your business is worth before you go through this process. But what's really important is that you speak to someone like Ray and understand that that's going to provide the amount of capital that you need to accomplish the goals that you want post-transaction. And Jason, the person who's going to speak afterwards, and John, they're going to help you plan and make sure that you're in the right position so that when you can capitalize on, everyone focuses on that top line value number, but it's what you keep. And all the planning that you do before is critical to making sure that you keep as much of that money as possible. So when you look at the different kinds of buyers, we look at, strategic and financial buyers. There is a tremendous amount of money that both groups have right now that are looking to put to work. What are the difference? And when we work with a company, we always advise them, if you're going to go through the sale process, you want to speak to both groups. You never know who's going to offer you the most value. You never know who's going to offer you the most interesting situation. And, we want you to have those options. You can always say yes and no to what you feel is right. But at the end of the day, you want to know what your options are because you're going to go through this process once. And you want to make sure that you maximize value and that you find the right exit strategy for your business. What are the difference between the strategic and the financial buyer? A strategic buyer is very focused on, what can they do to take your business, plug it into their company, and make it more valuable. Some of that is got to be, how do we take the products you manufacture or produce or people you have in your company and we make them more valuable. They also look at how do we cut costs and take that, maybe we're going to pay 7 times EBITDA for your company, but how do we make that 4 or 5? And there's potentially they look at cost reductions, and it's something that you obviously need to be aware of. But what's great is they're going to, they're going to pay in cash. It allows you to transition out of your business faster. Usually sometimes they don't want the owner there for a long period of time. Sometimes they do. But in understanding what you want and what that goal is and communicating that to the buyer is critical. In terms of financial buyers, they're very focused on return. So how they buy the company, how it's leveraged, it's very important to them. They want to make sure if you're the platform, that's the company at the top, that you have the management team that can continue to grow. They want to have the team that will maybe be able to go out and buy other companies, fold them in, make them more valuable, increase that EBITDA multiple over time. For a business owner, what's also can be attractive about that is we talk about the second bite of the apple. Usually you roll over some equity into that company, and it gives you the opportunity when that company sells again to get another payday. Is that payday sometimes it's equal to the first one? Sometimes it's more. That's what they're hoping for, and that's what they're really trying to sell the business owner on. Now, when we look at financial buyers, there's really 2 different types that we can break it down to. There are the ones that have deep industry resources. They're going to bring them to your company, and they're going to help you grow that company and by using those resources and utilizing the network that they've built up over time. And that's great for some businesses. But some business owners, they want an entity that's going to be behind them, that's going to be less involved with the business, but help them grow at critical junctures. And both of them are good solutions. It's just a matter of what the business owner wants. And again, it's more about options. We want to bring both of those to you so you can examine and make a determination of what you think is best for you. ESOP, it's another way of selling your business. There are tremendous tax advantages to it that allow you to keep more of your money. There are flexibility in terms of how much you can sell. There are you can retain control, and it's a great benefit for your employees because what happens is you sell some of your stock to a trust. The trust distributes an interest in those shares to your employees over time, and it's a great incentive for the employees who work for your company to accumulate wealth. I mean, some of the great success stories you'll see in ESOPs, you look at a company like UPS. They were an ESOP. They had they had a substantial portion of their equity that was held by the ESOP, I believe, and they had drivers who were millionaires once the company went public. Now, that's a tremendous success story. Another one would be Publix. I don't know if you're in the South and you go food shopping. They're an ESOP as well. And you'll have people who are working behind the deli counter or working in the produce department have also accumulated a tremendous amount of wealth. They keep their employees for a long period of time because the benefits continue to accumulate towards them. And it's just it's another great way to sell your company. It's not for everybody because, I'll go to the pros and cons. I'll start with ESOP first. I mean, the benefits obviously are on the tax side and the liquidity. And, when I address the shareholders to gain ownership. Some of the risks, it is governed by ERISA, so there's some regulatory oversight. It's like your 401k plan of your company. You need to make sure it's managed and it's being run in the interest of the employees. You need to use debt to take the money out. It's very hard to get full liquidity on day one. It's usually, sometimes it needs to be either you sell your stock over time or you take a seller note and you have to wait to get that money out for an extended period of time because the banks will want to get their money first. On terms of 100% sale, a buyout, that's more of the strategic. We look at it's a great reduction of your risk, and you get the capital that's able to be invested. It's instant diversification for your portfolio. As I mentioned before, it allows for retirement for business owners that are looking to transition out. It's a great option for them because it allows them to get out of their business faster. In terms of some of the negatives, they lose operational control. That's always a challenge for business owners. Many times we speak to a business owner and they say, I haven't taken an order from anyone for 30 years, and now I have to listen to somebody else and tell me what to do. And that's a challenge. Usually people work through it, or they find that they exit a little bit sooner because they're unhappy. But it's certainly an issue. And then, if you're selling 100% of your stock, you miss out on the upside that the company can bring. You're going to not get that opportunity, but you have the opportunity of putting that money into a well-thought-out investment plan and get that kind of growth. In terms of a sponsor-led recapitalization, it's usually, as I said, it's a partial sale, and they want you to roll over a portion of your equity, so you're not getting the full value on day one, but you do get the benefits of that leverage and rolling over a smaller portion of your value to get a much higher value ownership stake in the business. And I can certainly walk through that if that would make sense, if people have questions about that. You are typically running the company, which is a plus. But then you have also a new boss, and you can have the potential for new conflicts with them. You have a board that's going to be governing you. You need to make sure you're comfortable. Part of what we advocate for business owners, whether they sell to a strategic buyer or to a private equity group, interviews. Talk to the people they've bought before. Make sure you're comfortable with what they've done, how they behave. The way they're behaving today, is that going to be the same way they behave 6 months from now? Because you want to make sure that you're going to be comfortable and that these company, especially if you're leaving, that they're going to be a good manager, they're going to take care of your employees. That's obviously critical. But it's also, when you go through the process, and this has been mentioned several times, is you sign that letter of intent, how honorable are they going to be? If they don't find any issues, are they going to try to renegotiate the deal at some point and try to create some issue that will help them renegotiate? Or will they stick to the letter of intent? Some of that you can mitigate by being prepared and going through the steps of preparing your business. But the next step is finding out how this group acts and how they're going to behave through the process. If you have any questions, I'm happy to ask them, address them.
I just want to add to that, due diligence works both ways during a transaction, right? So everybody thinks if you're selling that due diligence will be coming your way. But doing your own due diligence of the acquirer or whatever it is just as critical. That's a really solid point.
Absolutely, and you're gonna go through management meetings with potential buyers, and we always say it's a two-way interview. You're not coming in and just being interviewed by the buyer to see if this is, the right company for them to buy. You need to ask the right questions to make sure that they're the right owners for your company, and that you are asking the questions that makes you comfortable with taking the next steps.
And I'll just piggyback on that, actually. I mean, I've been in situations where I'm representing a seller, and there's a very, very difficult negotiation, and the buyer is just really being difficult, changing their mind, not being consistent. And sometimes I turn around to that seller where it's a management rollover, a situation where the owner's going to stay involved and say, can you really work with these people after the deal? Do you want that? So it's important to understand who you're selling to, who's on the other side.
Yes, absolutely, and that's some of the benefit that an intermediary can provide, is helping you understand that, what's normal and what's just negotiation, and trying to be a little bit of a buffer in terms of, some difficult negotiating points, and how do you get through them without getting offended, because it gets heated. There's always going to be a point in the negotiation where you're going to get frustrated with the buyer, and the buyer's going to get frustrated with you. And you need to figure out how to work through that instead of letting the moment carry through and ruin the deal.
What are some of the pitfalls of owners trying to negotiate a deal themselves?
Well,
I'm sure you've seen that before.
yes.
And that's to both of you, I guess, over there.
Well, I would say, just to my point before, that an owner will, and rightfully so, they have a very strong, they feel very strongly about their company. And they have a lot of, and anybody who asks a question that could potentially be perceived as being negative, they might be offended. And even though it's not an offensive question, I've had business owners who said, I don't understand why they need to do any due diligence. I'm telling them these are the numbers, and if they can't believe me, then, we shouldn't be moving forward. And I explained to them, they've got a board, or they've got, limited partners in their private, that have invested in their fund, and they need to answer to them. And if they can't say, you're saying you've got 10 million in EBITDA, and if they don't do the work that says you really have 10 million in EBITDA, and they find out 6 weeks later that 10 is really 5, well, those guys are going to be out of a job, because they need to do their work. And so it's really acting as that buffer, and protecting the owner from getting offended from a lot of situations. It's also, owners haven't been through this before. Many owners, it's the first time they're going to sell their business, and the only time they're going to sell the business. And they need professionals around them that have been there before, that can explain to them what's normal, what's not normal, and help them work through it. We do some buy-side work as well, and sometimes the other side doesn't have good advisors around them, and you could see issues that are raised that you wouldn't necessarily want to see raised. And we focus on items that we shouldn't be spending a lot of time on, and it creates a problem. So working with people who've been there before and that can help you guide you through this and be that buffer, it's critical.
I want to add also, what we see in our practice is some of the biggest pitfalls to a deal getting done are from the owner themselves, because even though they have great intentions, you can be sitting at the table and you're just like, don't say anything, don't say anything, don't say anything, because what's coming out of their mouth is going to be a problem. We've done deals where we take them to auction, right? And there's a whole auction process as we take owners out to the market. And I've gotten calls from companies. They're like, I didn't know this was for sale. And the owner is going around throwing out numbers and doing this and being totally counterproductive to the process. And it can absolutely drive value right to the ground. So yeah, dealing with owners can sometimes be the biggest pitfall, the thing, leave it to the experts.
And as you, and as you get further along the process and you go through the sale process, the business owner's got two jobs. I mean, they got to run their company and make sure that everything continues to go well, and then they got to deal with everything that we're asking for them, all the information requests, the meetings, and you go through this 6-9 month period. It can become wearing, and they get tired, and rightfully so. And so, especially as you go through this and you get to the latter stages, you really need that help from people who can protect you and provide the guidance to get you through that situation.
Yeah, I was going to say, I've certainly had situations where my client or the client on the other side of the deal says, you know what, I don't need the lawyers to talk about this. I'm just going to address this point. And they think they're going to save money, or they think they're going to get it done more quickly, or they're going to look honest to the other side. And I had a deal recently where there was a call, and all the lawyers were on the call, and it was mainly legal points we were discussing. And the owner on the other side just took over the call, did not let his lawyers speak, and was forcing my client to answer. I'm trying to like throw myself in front of a bullet here to say, stop talking, stop talking. Client keeps talking. And I will say that how deals usually work, and oftentimes you can avoid a lot of problems by doing that.
So before I introduce Jason, I apologize to everybody. I got to do this. I've been so focused on introducing everybody else, I don't think I really introduced myself. So I'm going to take 30 seconds. My name is Jeffrey Cates. I'm a partner at the Founders Group. We do business transaction advisory services. We're in Southern California, Los Angeles, and New York. We really take business owners through the process right from beginning to end, and we work with collaborative teams along the way with CPAs, with attorneys to kind of manage the process, add value, put a process in place, and take an owner through transition. So I apologize, but just wanted to get that out there. And without further ado, Jason Navarino from Riker is going to talk to us today about the team and the transition process.
Sure. So my name is Jason Navarino. I'm a tax and corporate partner at Riker, Danzig, Scherer, Highland, and Peretti. We're based in Morristown, New Jersey, with offices in Trenton and in New York City as well, where I'm actually heading to later today. We're a full-service law firm. Our corporate and tax practice is focused on middle-market businesses, middle-market business owners through all stages of the business cycle, from startup, governance, day-to-day issues, commercial contracts, to acquisitions for growth, exit transactions, and all things of that nature. So I'm going to talk now about the process and who's on the team. And I think the other speakers have all touched on this a little bit, so I'm going to be recapping a bit in the next few minutes, and also giving you a little preview of the next couple sessions as well, because all the things I'm about to talk about now, we're going to go into more depth in the next two sessions. So we've talked time and time again, that's what our group is about having the right team of advisors, building that team. And so who should be on that team? Who do you need to have there in place? So I've got two slides on this. Not surprisingly, as a lawyer, I've dedicated a whole slide to the lawyers. But this is not to say that you need to go out today and hire a lawyer in each of these categories. I've listed a bunch of areas of practice that are relevant to a deal. And it's important to understand that the lawyer, you need to have expertise in these different areas, and it's very rare for a single lawyer to have expertise in all of these areas. You know, you will find some solo attorneys who say, yeah, I can do the whole sale for you, and maybe in a very small transaction that makes sense. But, you know, when you have real estate, particularly real estate with some industrial activity going on there, having an environmental lawyer is extremely important, or having a lawyer who has access to an environmental specialist is extremely important, especially if you're selling a business here in New Jersey and you've got to deal with the Industrial Site Recovery Act. If you have intellectual property in the business, having an IP lawyer who understands registrations, who understands protecting that IP, extremely important. There are some corporate lawyers who do that themselves, but there are other times where it's important to have that specialist knowledge on board, not necessarily involved in the deal on a day-to-day basis, but to have that person at the firm or available to answer questions and get involved as necessary. Any deal where there are employees in the company, I am involving my employee benefits and ERISA specialist. ERISA is complicated. If you don't know it, be careful. It is a complex area of law, and so to have a specialist in that area is really helpful when you're working on a deal where there are qualified plans involved. Labor and employment issues come up. Certainly, if there are labor unions involved in the business, it's absolutely important to understand the ramifications of that on both the buy and the sell side, but also just general employment issues even without regard to unions. If you have a WARN Act notification requirement, depending on the number of employees, if you're selling the company, that's not something that you want to mess with. Have you classified employees and independent contractors correctly? That's often a huge issue in due diligence. And obviously, if the business has permits, licenses, needs certain approvals to do the deal from various governmental agencies, having governmental affairs capacity, people who are experienced in talking to those regulators can be very helpful. I skipped the first two bullets, of course, that's myself, the corporate and M&A lawyer and the tax lawyer. The corporate and M&A lawyer is generally the quarterback of the deal once you get to that certain point where you're negotiating terms, negotiating the documents, working on those documents. That attorney becomes very important to understand the process, to work with not only the legal team but the other advisors as well. And tax, I remember a corporate partner at my first law firm said a tax lawyer's like the old credit card commercial, don't leave home without it. Understanding the tax ramifications of a deal, extremely important. The income tax ramifications and the estate and gift tax ramifications in the individual context. Now, some people will say, well, wait a second, I have an accountant for that. What do I need a tax lawyer to? Or do I need a tax lawyer and a tax accountant? My answer is yes. Yes, you do. They both know the same Internal Revenue Code, but they know them from different perspectives. The tax accountant is likely going to be better at modeling things out, running calculations, figuring out how things run through returns. The tax lawyer is going to understand, structuring actually is something that both do. And I find that the best tax structures are when the lawyer and the accountant bring their expertise together and collaborate. The tax lawyer is going to understand that if we say this in the contract, we get this outcome. If we say this in the contract, we get this outcome. Understand how you can manipulate the legal documents, the legal aspects of the deal in order to get a better tax result. So there is expertise there both in the tax lawyer and the tax accountant. There's some overlap, but it's not entirely the case. So having access to lawyers with these various specialties is very helpful certainly in middle market deals. And then there's the rest of the team, of course. The accountants that I've talked about, everybody else, you don't need to worry about them. Accountants, extremely important in understanding the financial situation of the company, running the calculations, figuring out if you change this, how does that impact this. Financial statements are a huge part of diligence, a huge part of understanding a business, working through various contingencies, various permutations. Brokers, investment bankers, Mike's already talked about what he does, extremely important. If you're a seller and you can't find a buyer, there's not going to be a deal to be had. Lenders and commercial bankers, obviously important if there's going to be any leverage in the deal to finance it. Extremely important to have that relationship, to be able to work with them quickly, especially if there are changes in the terms, in the basic deal structure as you move on, being able to work with the lender to accommodate that. Financial advisors, as Ray's talked about, obviously important to understand your personal situation, what you want out of the deal, what you want after the deal. Insurance brokers, if you've got insurance policies tied up in the business, life insurance policies existing, or if it becomes useful in the deal to have a life insurance policy in there, or to look at other insurance policies that affect the business, health insurance, for example, to have that relationship. When you have family businesses, oftentimes there are interesting relationships that pop up, interesting dynamics in the family, and to maybe work those through with someone. There are family business consultants. We have one in our group, actually, to talk through these issues and understand how you help people work together within the family to get to a common goal, or decide whether that's even doable or not. I have a client right now where it's a family business, and the solution is to divide it into two businesses because the family should not be working in the same business anymore. That happens. And of course, having input from other family members, from your top management, from your key employees, having people on the same page, all rowing in the same direction is very important. All right, so you have your team, and now the process for the deal. And I think we've covered a lot of this already, and this slide really talking about being prepared for the deal. This is actually going to be our next session. In the next session, we'll be talking about the things you should do to prepare for a transaction. But being prepared is extremely important, like the Boy Scouts say. You got to know your business. You know, you've got to understand the strengths and weaknesses of your business. You've got to understand what opportunities are out there for growth, what your potential liabilities are. You want to know about it before the buyer discovers it in due diligence. What upcoming needs you're going to have in terms of CapEx, in terms of replacing, retiring employees. Understand that so you can deal with it or be on top of it or address it before the buyer finds it. One legal aspect here, making sure you have your key documents in place. You know, when I talk to a client and say, okay, do you have your operating agreement, you have your bylaws, you have your leases, and they look at me and like, well, I think we have them somewhere. Good time before you start the deal process to get them out, look at them, make sure you're complying with those. If they don't reflect reality, update them before you get into the deal and before that can create problems. And of course, understand the financial situation of the company. Very important to understand that before you move forward. I have a lot of horror stories for some reason. But I had a client several years ago who had decided they were going to sell the company, had already bought the house in Florida, quit their country club, had made all the plans to move out, and they didn't do an auction process. They had one buyer they were going to sell to. Everybody knew about it at this point. The deal had to go forward, and it turned out they had their worst year of sales ever leading up to that, and the price just went lower and lower and lower, and they were locked in at that point. They had no contingency. They didn't understand it. They didn't see that coming. They hadn't thought about it, and unfortunately, they were so far along at that point that they were stuck. So that's the type of situation you want to try to avoid. Understand it in advance. Have a sense of what's coming. Know your business. Know your options. Know what's out there. Talk to these guys. Find out what the market's like. What possible exits there are for you. Understand the market. Is it a healthy market? Is it a frothy market? Is it a declining market? Understand that, and is now the time to go out on the market. Know what you need and what you want financially. Where does this fit into your overall life plan? And as I just mentioned with my horror story, know how to say no if you need to. If now's not the time to sell, we'll try again in a few years. So that's going to be our next session. Our final session, then we're going to talk about the rest of the process. So once you're prepared, obviously you've got to choose your path. Do you want to do an ESOP? Do you want to do an auction process? Do you have a particular strategic buyer that just makes sense to negotiate exclusively with? Figure out what you're going to do. Then you're usually deciding on key terms with them. There'll typically be some preliminary due diligence at this point, mainly of a financial nature, so that the buyer can understand what your business is and how much they should be making an offer for. And basic structural issues. Is it going to be a stock deal? Is it going to be an asset deal? What are the tax ramifications? What are the liability ramifications? What are the licensing and permitting ramifications of going one way or the other? And when you have a decision on those key terms, typically then they'll be reflected in a letter of intent, an LOI, or a term sheet, usually non-binding. I've occasionally seen people talk about binding term sheets. We can then have a whole legal lecture on the enforceability of those. Typically non-binding except as to exclusivity and confidentiality. If you have a single buyer, typically they'll say, we want you to give us 30, 60 days where you're just talking to us and nobody else. And then at that point, the next step is usually due diligence, the full-on diligence. Going deeper on the financials, looking at operations, if it's a strategic buyer, how are you going to integrate the seller's operations with your own? And a lot of legal diligence, looking at the contracts, looking at the leases, looking at the permits, looking at any ongoing litigation, understanding what risks there are, what potential costs may be coming down the road. And that will often then lead right into the next step, which is the definitive agreement. This is going to be your stock purchase agreement, your asset purchase agreement, membership interest purchase agreement, merger agreement, depending on the structure of the deal. This is the document that's going to reflect the basic terms, the price, when and how it's going to get delivered. Is it cash? Is it a note? Is there an earn-out involved based on future performance? Working capital adjustment, how's that going to work? A huge part of it, and perhaps the most important for a seller to read, are the reps and warranties. That ties right into the diligence. The buyer's doing diligence, but they also want the seller to stand behind it and make representations that my business is validly organized, my financial statements are accurate, I don't have any unknown liabilities, my taxes are paid, I don't have any unions lurking in the background. They're going to look for those reps and warranties, and then that's going to be very important because if it turns out those reps and warranties aren't true before you get to closing, the buyer can walk away. If it turns out they're not true after you close, the buyer can bring a claim for indemnification, and you're going to be giving back some of your purchase price. So the seller does need to think about those reps and warranties very carefully, and the more problems you have in the due diligence process, the more the buyer is going to ask for in terms of reps and warranties to be protected. You'll have some closing conditions, additional provisions as well. Ultimately, you sign the definitive agreement, and then you move on to ancillary agreements. If there's going to be key employees, if the seller is going to stay on as an employee in the company, negotiating the terms of the employment agreement, of any leases, if there's third-party consents that are required, new permits that are needed. After you sign the definitive agreement, that's when you're typically going to go out and get those. And once all that's in place, all the ancillary agreements, all of the consents are in place, then you close the deal. You celebrate, you change ownership, everybody's happy until there's a working capital adjustment or something comes up with the reps and warranties. But again, understanding what you're getting into in advance is important to that so you can prepare. And of course, there's the non-deal aspects of closing and getting past it, living out the rest of your life, enjoying this cash that you've hopefully accumulated on the deal, doing the other things you want to do in life if you've planned accordingly, have handled all of your taxes, and can live on successfully after that deal.
Thank you, Jason. I got a question for you. When, we talk about a lot of advisors. When do you bring them in, like timing-wise? When's the best time to bring advisors in?
Flip back on the slides a little bit. Well, I'd love to say you should get the lawyers involved right away at the very beginning and keep them involved the whole process. But truth be told, I'm often not the first person in the deal, and that's not the wrong way to do it. You may have a lawyer that's been involved in the business for a while, and if they have the capacity for a deal, great. But I think, the first people you want to talk to are the financial advisor to understand where you are personally, what your goals are, what you want to accomplish. The accountants to understand the business, make sure it's financially healthy, make sure you have a good grasp on that. The investment banker to understand what your options are. And if there's any lawyer that you might want to talk to early on, it would probably be the trust and estates lawyer as well, to coordinate with the financial plan, to think about, what are your gifting goals, what are tax efficient strategies, if it makes sense to grow the business in a trust, for instance, and then have the trust sell it, you've got to implement that before the sale and before it's documented that the company has truly appreciated. And so it's important to think about that in advance. Get the business healthy, understand what's out there, and then perhaps bring in the more deal-specific advisors later on.
Now,
Cool.
can I ask that question a little bit differently? So everything we've talked about is really us planning, for an exit strategy. We're in a position where we get solicited quite frequently to be acquired. So how far down this road do we go for just on the off chance that somebody comes in and, it looks like the right time, even though it wasn't planned for? Should we do every step that you just said up to, bringing in the deal attorney, or how much of this process do we go through? Because obviously this comes with an expense, which leads to my second question probably for you. By bringing a collaborative team together, what is the ROI? Because obviously, like I said, there's going to be expense to putting this team together.
So you go first, and then I'll answer them.
Sure. So what I would say is I don't think you need the deal attorney to evaluate the initial proposal. As much as I'd love to be involved in that, I think the first thing is just understanding, is it, personally, does that make sense for you? Does it make sense to exit at this point in time? So is your personal situation in order? And again, that's your financial advisors, your trust and estates attorney. And then, accountants and valuation expert to assess the offer. Is this a good offer? Is this a great offer? We really got to jump on it. And if so, we'll find out. We'll put the team together as quickly as we can. Or no, this offer's not that great. We can move on and see if they up the offer a bit. So I think you want to make sure your personal situation is in place to deal with that, and having people that you can reach out to advise you on the offer, and then you can build the rest of the team.
So it's funny you brought that up, because I wanted to talk about that, and I have a note here as in conclusion is, okay, you're talking about all these advisors, and obviously there's costs involved, and there's no question. And I think your point about the return is very key. I'm going to use an example, very simple, but I'll do it anyway. let's say your business is doing 30 million in revenues with a 5 million EBITDA, okay? And you've normalized that. Let's say it's normalized 5 million. And for those, normalized means you're adding back the owner's salaries. If you're not paying fair rent, you know, you got to take care of that as part of what your true value is. Let's say it's 5 million. And you bring together, you know, the accountant, a business advisor such as myself, where we're trying to add value on the top line throughout the business. What you're trying to do is add to EBITDA, but also add to the multiple. So with a multiple of, let's say, 5, it's worth $25 million, almost one-time sale. Now, if we do nothing else, okay, but internally prepare the business so that now you're getting a multiple of 6, there's a $5 million add to value there, okay? So if you've spent $250,000 on fees over a course of 2 years, you spend $500,000, you're getting 10 times the return on your money, right? And what you're doing is you're just preparing the business, but in reality, it's still good business practice, right? So whatever you're doing to prepare a business for sale is probably what you should be doing effectively to run the business, and other stuff may follow. So for instance, if your sales team isn't strong, okay, and you're still doing 30 million, but you know you have an issue with your sales director or some business development or distributors, right? And you got to take a look at that. Working with advisors, okay, that can help you focus what your initiatives are, so that it keeps you focused, that gets sales from 30 to 35, and now EBITDA is at 7, okay? So now it's not worth 35 on that 5, but at a multiple of 6, it's now worth 42. So now you're up $17 million in, let's say, 2 to 3 years in terms of value. Doesn't matter if you spend $1 million in fees. You're up 16. So that's how we look at it from our perspective as a company, and what we're bringing to owners is it's not just about, I mean, the costs are what they are, but if they're adding value to what you're getting out of it, it's a smart spend. So that would be my answer to that question.
I had just a couple points I wanted to add there. A lot of, like every privately owned business, you get a lot of letters soliciting, you know, saying, you know, I either represent someone who would be interested in buying your company, or we're working with this group, or we're with XYZ firm. And what we have found is, because a lot of people will come to us and say, you know, I've been approached by this private equity group, this guy saying he has a buyer, is unless there's a name on the letter that says, I work for XYZ company, it's probably not worth pursuing. And because a lot of what you will receive is just phishing.
Yeah,
And yeah, and I would say even with the private equity groups, a lot of that is phishing as well. We help companies make acquisitions, and we're always certain to put the name of the company on the letter, because we want them to identify who that company is and say, all right, I know who this company is, I can look them up, or I've probably been competing against them, and I know that this is probably a real group that's interested. In terms of how far you want to go down with them, a lot of what we hear is companies approach, they go through like a 6, 9, 12-month period where they're providing lots of information, and they're always struggling to get to value. That to me is an awful outcome, because you're wasting your time, you're giving them valuable information, and you're not getting to the place that you want to be. Usually bringing in an advisor who says, we need you to, here's what we'll give you, you need to tell us what you want, how we're going to value you pretty quickly. And there's real value to that, and that's usually not a lot of cost to that, because you need to figure out if this person is real or not. And the last thing I'd say is, in terms of creating value, a lot of times someone approaching a business owner and saying, you know, we're willing to pay 5 times for your business is a great way that people come to us and say, oh, is this a good offer? Is this a legitimate offer? Is this what we're really worth? You know, what we try to do, and we don't charge for this, is we tell you, is that a real offer? And if it's a real offer, we're going to tell you, and maybe there's a way we can help you to get to the end. Maybe there's not. Maybe you have the group around you that can do it, and you don't need our services. But if someone's undervaluing you, we're going to tell you, and we're going to say, if we go out to market, we think it could, we could tell you for 6, 7 times, and then you're, you know, to the point before, you know, you're getting real value there because you're getting an appreciation in the multiple that's going to be paid for you, and I would say that dramatically dwarfs the fees that any of us would ever charge.
Mike, you just reminded me of something. I want to make this point. As a lawyer, I'd be remiss if I didn't mention this. If you start receiving those solicitations or you go down this road in any way, before you start sharing any information, 3 letters you need to remember, NDA.
Yeah.
Make sure you have that confidentiality agreement in place before you start sharing information with anyone, with a private equity fund, certainly, obviously, with a competitor. You know, once that information's out the door, you can't get it back in. So having those protections in place, absolutely important. NDAs are not particularly complicated agreements, but just pulling a form off the internet, you got to be a little careful with that. Talk to the lawyer about it. It won't cost you very much, I promise.
So before we finish, I just want to, there's other members of our group that didn't speak today, but I'd like them to introduce themselves. You'll be hearing from them in future sessions, but I just wanted to give time for that. So I guess, Jeanette, why don't we start with you and take a few seconds or a minute or two to introduce yourself?
All right.
And we'll go around the room for,
Thanks, Jeff. My name is Jeanette Emmons. I work with Witham Smith & Brown. We're a large regional CPA firm, top 25. I personally have been in public accounting for over 20 years. Almost 20 of that, a great deal of my time was spent in the traditional practice, accounting, advisory, audit, tax. And then over the last 5 to 10 years have really become to focus on the transaction world. I'm working with Jim Weeks to build our transaction advisory services group, taking it to the next level. We work with our traditional clients on the sell side, building value, making sure they get the value that they need, and also doing quality of earnings and financial due diligence buy and sell side. So we can bring those fun war stories from both sides of the table. So yeah, next time I'll be talking about preparing the books, the records, the management, and so forth. So that's for the next session.
Dan Reardon with UBS Certus Financial Group, partners with Ray for 14 years, engaged in the middle markets, as Ray explained earlier. On the discipline of mine is particularly on the corporate welfare and benefit packages, 401ks, cash balance plans, anything HR and ERISA related is my specialty for the team, in addition to life insurance and long-term care planning, key hot buttons in the marketplace today for folks that know that long-term care crises are going to happen. Of course, I do investment planning, financial planning as well, but I'm part of a 9-person team of which Ray leads. And I'll be at some point speaking, most likely as a moderator, because Ray pretty much covered anything I might have said, but I'll see you at the next sessions. Thank you.
Steve Pagano from Riker Danzig Sher Highland Preddy, their attorney. I am the trust and estates attorney, so I'm one of those folks to try to get involved early, potentially help you and the family kind of get things going in the right direction, saving estate taxes, and setting the family up correctly for the future. Look forward to speaking next time, and this is great, guys. Good job. Thank you.
So let's go on. The next session will be in 3 weeks from today. We'll be on preparing the business. We're going to get into some more depth with regards to what should be involved in preparation. And then 3 weeks after that, we'll be on the execution side and life after the deal. We hope, and I'm speaking for the team, we hope we found this very informative. We didn't go into too much depth today, just overall, there'll be some more gravitas in the next couple sessions. It was not meant to be there was not scare tactics involved here today. And we hope there wasn't, at least. We hope that you realize this is just good business sense in helping to plan to run your business on a day-to-day basis, and that there's a lot to think about because you will be transitioning your business. One of the things we didn't really cover today, because we talked a lot about external transitions, is there's a lot of internal options too, right? Like multi-generational transfer to children, siblings, and that's a big part of it too. So even though we may not have covered it today, we'll be getting to that going forward as well, if that is your personal situation. So we hope you enjoyed it, and we hope that you got some key points to certainly start thinking about, because you will be transitioning your business, as Ray said. So we thank you for coming today, and we look forward to seeing you in a couple weeks.